Welcome back to Investing Talk Podcast. It is February 8th, 2026, and today we are looking at a company that has been, well, a battleground stock for the last 5 years. But looking at the latest data, it feels like the war might finally be over. We are dissecting a fintech player that has finally crossed a major psychological and financial threshold. I mean, hitting the $1 billion quarterly revenue mark for the very first time.
Today we're looking at SoFi Technologies.
And honestly, looking at the numbers coming out of Q4 2025, it really feels like a pivotal moment. For years, the question was whether this company was just a glorified lender or a legitimate tech platform. But as always, we need to see if the hype, matches the reality.
Exactly. And so what here isn't just about a good quarter or even a record quarter. It's about the fundamental shift in their identity. We're seeing the transition from a niche lender into, well, a diversified financial powerhouse. The agentic AI strategy, which we'll get into, is finally paying off in the margins, and the guidance raise for 2026 is massive.
It is a big claim. But before we get into the weeds, as usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us keep the lights on and the data flowing.
Absolutely. So where do you want to start?
Let's let under the hood. We have to start with the top line because that's the headline grabber.
It really is. SoFi reported record Q4 2025 net revenue of $1.03 billion. That is up 37% year over year.
And just to pause there, crossing that $1 billion threshold in a single quarter, that is a massive psychological barrier for the market, right?
Oh, for sure.
It's the difference between the minor leagues and the majors. It moves a company from promising startup to established heavy hitter in the eyes of many institutional investors.
Yeah.
When you see a B next to the quarterly revenue, the valuation models change.
It validates the scale. You can't fake $1 billion in a quarter. And what's driving it isn't just one thing. If you look at the lending velocity, it's incredible. They saw a 46% surge in total loan origination volume, hitting $10.5 billion.
Right, and I dug into that breakdown because I was skeptical. Usually when a fintech shows massive loan growth, it's because they're taking on dangerous high-risk personal loans to bump the numbers. Personals were huge at $7.5 billion, sure. But what caught my eye was the resurgence in student loans.
Exactly. Student loans came in at $1.9 billion, which is up 38%. You have to remember, that business was dead in the water for a while due to the regulatory freezes and the moratoriums a few years back. Seeing that bounce back is a significant tailwind. It shows the core business is healthy and that people are actively managing their debt again.
It's interesting because for a long time, the bear case was SoFi's just a student loan company. Then became SoFi's just a personal loan company.
Yeah.
But here's the twist, and this is where I start to listen to the bull case a bit more closely.
Go.
For the longest time, the knock on SoFi was, it's just a bank without branches. It's just a lender. If interest rates go weird, they die.
That is the old narrative. If you look at this report, the non-lending segments, that's the technology platform and the financial services arm, now comprise 57% of revenue.
That is the key stat for me. 57%.
It's the majority of their business now. This is the argument for diversification. They are no longer completely at the mercy of interest rate fluctuations because the tech platform and the financial services fees provide that ballast.
Let's break that down for the listener because tech platform sounds vague. We're talking about their ownership of Galileo and Technisys, right?
Precisely.
These are the back-end infrastructure pieces that other banks and fintechs use to run their systems.
Exactly. Think of it like Amazon and AWS. Amazon started selling books, but the real profit engine became AWS, the cloud infrastructure that runs the internet. SoFi's tech platform is trying to be the AWS of fintech.
Right.
They are processing payments, hosting accounts, and running the cyberbank core for other companies. So even if SoFi isn't lending you money, they might be powering the debit card in your wallet from a totally different neobank.
Which makes that revenue much stickier. It's recurring, not just a one-time transaction fee. But I have to play the skeptic, though. Revenue's vanity, profit is sanity, right?
Yes.
Growing the top line is easy if you're burning cash to do it. We saw that in 2021, growth at all costs, and then the stock crashed.
Fair point. But look at the bottom line. This isn't empty calorie growth anymore.
I did look. They posted an EPS earnings per share of 13 cents. The consensus on the street was 12 cents.
So they beat by over 8%.
They did, and net income came in at $174 million. But what impresses me more than the single quarter number is the consistency. This extends their streak to 9 consecutive quarters of GAAP profitability.
And we need to stress gap here. This isn't adjusted EBITDA or some made-up metric where they exclude all the bad stuff like stock-based compensation. This is generally accepted accounting principles, real profit.
That's over 2 years of real profits. You can't call it a fluke anymore. It signals that the business model actually works at scale. And looking ahead, the 2026 outlook is what really got the growth investors excited.
They raised the guidance for the full fiscal year of 2026. They're targeting total revenue of $4.66 billion.
Okay.
That implies about 30% growth year over year. And for earnings, they're looking at 60 cents per share. That's 54% earnings growth.
That is aggressive growth for a company of this size.
Yeah.
54% earnings growth. That is hard to find in the financial sector. Usually you see banks growing at, 5% or 8%?
Yeah.
But we have to ask how they're achieving this leverage. It's not magic.
It comes down to the balance sheet mechanics.
It's the deposits. I was looking at the liability side of the balance sheet. They're sitting on $37.5 billion in deposits.
Which is massive.
It is. And for the listener, here's why that matters. In an environment where other fintechs are having to go to Wall Street and borrow money at 6% or 7% to lend it out, their margins get crushed.
Right.
So SoFi has this sticky, low-cost funding base. They're using their members' checking and savings accounts to fund their loans.
Exactly. If they pay you 4% on your savings, but lend it out at 12% or 13% for a personal loan, they keep that spread. And because they are a bank, they don't have to beg hedge funds for capital. They are self-funded.
And don't forget the operational side. They mentioned the agentic AI tools significantly reducing the cost to serve. Now, agentic AI is a bit of a buzzword. Everyone puts AI in their earnings release to pump the stock. What does that actually look like in practice here?
It's more than just a chatbot. Agentic means the AI has agency. It can perform tasks, not just answer questions. So imagine a customer wants to refinance a loan or dispute a charge. Instead of a human agent spending 20 minutes clicking through screens, the AI agent handles the verification, the document pulls, and the decisioning in seconds.
So it's efficiency at scale. It's not just about firing support staff. It's about handling volume without hiring more staff.
It cuts the cost to serve dramatically.
Yeah.
When you combine low cost of capital, thanks to those deposits, with low cost of operations, thanks to AI, and you spread that over a member base of 13.7 million people, 13.7 million is a lot of people to cross-sell to.
It is. That flywheel is finally spinning at full speed. You get them in for a high-yield savings account, and suddenly the AI is offering them an auto loan or a credit card or life insurance. And because the data is integrated, the offer is actually relevant. It's not spam, it's a solution.
Okay, so the fundamentals look robust, I'll grant you that. The financial super app dream seems to be materializing. But the stock market doesn't always reflect the fundamentals in real time. Let's pivot to the charts.
Let's talk price action.
If you've been watching the ticker recently, you know there has been volatility. Despite these numbers, we saw a pullback recently.
We did, but if you look at the research coming out from the technical analysts, this pullback is being described as well overdone.
That's a common phrase when people are bag holding. It's overdone, please buy.
Cynical. But seriously, the charts show a structure here. There's a new technical floor that was established right after these Q4 earnings. The setup implies a breakout is coming. It's essentially a higher-low structure. Explain higher-low for someone who doesn't stare at candlesticks all day. Why is that significant?
Sure. It means that every time the stock drops, it stops dropping at a price higher than the previous drop. It shows that buyers are stepping in earlier and earlier. They aren't waiting for it to hit rock bottom anymore. The dip buyers are getting more aggressive.
I did notice the sentiment shifting to what some are calling a pound-the-table moment. It feels like the street was waiting for a reason to sell the news. They sold it, and now they're realizing they sold too low.
Exactly. It's a correction buying opportunity. The research suggests we're positioning for upside momentum back toward the 52-week highs.
What caught my eye was the flow data, the volume.
What are you seeing there?
Institutional interest has surged. We're seeing elevated volume specifically on the dips. That usually suggests the big players, the hedge funds, the pension funds, are accumulating shares.
Right, because they can't just buy 1 million shares at once or the price would skyrocket. They have to buy when everyone else is selling. They use the liquidity from the retail panic to build their positions.
Exactly. They let the retail panic sellers drive the price down, and then they scoop it up. If the big money is stepping in to defend this floor, that's a very bullish technical signal. It means the smart money thinks the price is wrong.
So the technicals are painting a picture of a coiled spring, but what about the broader vibe? Let's move to market sentiment.
Or what the street is saying.
The quantitative scores are fascinating here.
Yeah, looking at the data aggregating news and sentiment, the mood is decidedly bullish.
It is. If you run through the top market stories right now, the headlines are telling. Things like, recent pullback creates opportunity as 2026 catalysts line up, or sell-off looks well overdone as execution keeps improving.
It highlights a massive disconnect. You have a fearful market. Macro narrative, people are worried about the economy, inflation, wars, but then you have SoFi executing a blowout quarter. Usually execution wins eventually, but right now the macro is clouding the micro.
And the analysts are following the execution. We are seeing strong buy ratings and upgrades rolling in from the large banks immediately following that guidance beat. They're looking at that $4.66 billion revenue target and realizing their models were too conservative.
It's almost like the analysts were treating it like a risky startup and suddenly realized it's a cash flow positive bank. The re-rating takes time.
But markets also run on rumors. What's the whisper on the street?
Ah, the rumor mill. This is always the fun part.
There are a few speculative catalysts that people are talking about for 2026. The big one, potential S&P 500 inclusion.
That would be huge.
Changes the game entirely.
For those who don't know, to get into the S&P 500, you generally need to be profitable for the most recent quarter and the most recent year. SoFi has 9 straight quarters of profit. They're checking the boxes. They're arguably more qualified than some companies already in the index.
And if they get added, it forces all the passive index funds, the Vanguards, the BlackRocks, the retirement funds that track the S&P to buy the stock. They have no choice. It creates massive, indiscriminate buying pressure.
That is the passive bid. It locks up a huge chunk of the float. It essentially removes shares from the open market, which drives scarcity.
Exactly. Then there are rumors about M&A in the RegTech space, bolstering that tech platform even more.
And I heard some chatter about the expansion of SoFi USD merchant services.
Yes, trying to capture more of the transaction loop. It's all unconfirmed, but these are the whisper catalysts that keep the growth investors interested. They aren't just buying for today's earnings, they're buying for tomorrow's index inclusion.
Okay, you're getting me excited, but it is my job to be the buzzkill. We have to look at the risks. We can't just drink the Kool-Aid.
Fair enough. Lay out the bear case. What could go wrong?
First, there is the market risk. We touched on it, but the fearful market narrative is real. We're in 2026, but macro fear and rising yields can still drag everything down. If the 10-year Treasury spikes, fintechs get hammered. Doesn't matter how good your earnings are if the whole sector is dumping.
That explains the post-earnings volatility we saw. It wasn't SoFi specific, it was sector beta. When the tide goes out, all boats drop.
Exactly. But there's a specific risk I'm worried about, regulatory risks.
The CFPB.
The Consumer Financial Protection Bureau. There is a lot of scrutiny right now regarding AI in lending. SoFi is touting this agentic AI as their competitive advantage. But if the regulators decide that these AI models are biased or opaque or not compliant with fair lending laws, that's a massive target on their back.
That is a legitimate concern. AI regulation is the Wild West right now. If an AI denies a loan to a specific demographic more often than another, even if it's mathematically correct based on credit scores, it can be a legal nightmare.
Exactly. If they clamp down on how SoFi uses AI for underwriting or customer service, that efficiency advantage we talked about, it could evaporate. Or worse, they get hit with massive fines.
Here is the rebuttal to that, though.
Let's hear it.
First, on the macro risk. That $37.5 billion deposit base offers stability against macro shocks. They aren't relying on the capital markets to fund their loans. They have their own cash. That makes them much more resilient than they were 3 years ago.
That is true. They control their own destiny more than a pure marketplace lender like Upstart or Lending Club. They aren't passing the hat around to fund a mortgage.
And regarding the AI regulation, SoFi claims they have built a regulatory by design compliance infrastructure. They aren't just a tech company pretending to be a bank. They are a chartered national bank. They know how to deal with the CFPB. They argue their compliance costs are actually lower because the AI is built to follow the rules better than humans do. It creates an audit trail for every single decision.
Regulatory by design is a nice marketing slogan. We'll see if it holds up in court. But I will admit, having the bank charter forces a level of discipline that the unregulated fintechs don't have.
Skeptic to the end. But look, even if you factor in those risks, the synthesis from the market seems to be that the risks appear priced in, given the severity of the recent sell-off.
Meaning the stock is cheap enough that even if things go a little wrong, you aren't going to get wiped out.
Exactly. The downside seems capped by that technical floor we discussed. When a stock stops going down on bad macro news, that tells you something.
All right. We've looked at the fundamentals, which are strong. We've looked at the charts, which look ready to bounce. We've looked at the risks, which are real but manageable. Let's reach a verdict.
For me, the numbers speak for themselves. I'm assigning a bullish score of 9 out of 10.
9 out of 10. That is high praise. You don't give out nines very often.
It is. But here's the elevator pitch. Q4 2025 was a blowout. 1.03 billion in revenue with 37% growth is undeniable. The 2026 guidance of $4.66 billion validates the digital bank moat. They've crossed the chasm from startup to institution.
And the drivers.
It's the diversified revenue. 57% non-lending protects them from rate shifts. And that 13.7 million member base creates a compounding cross-sell effect that legacy banks just can't match. Legacy banks have branches, SoFi has data.
I will agree on the numbers. The profitability inflection is undeniable. 9 quarters of GAAP profit puts them in a different league than the rest of the fintech pack. They've proven the unit economics work.
And the timing. The recent pullback is a gift. It's an entry point ahead of those 2026 catalysts like the S&P inclusion and the AI expansion.
It does feel like buying a dollar for 80 cents right now. I think the market is lagging the reality of the business.
So what is the call?
I think we are aligned here.
It's a multi-year hold.
It's a multi-year hold. You hold this through the volatility because the long-term trend is up and to the right. This isn't a trade for next week. This is a position for the next 3 years.
Absolutely. The thesis is intact and strengthening.
Well, there you have it. A deep look at SoFi Technologies as they cross the billion-dollar quarterly mark. It's a company that has matured, found its footing, and is now starting to sprint.
It is going to be a fascinating year to watch. Thanks for tuning in.
Don't forget to subscribe, like, and comment to support the show. We will see you next time.